Hi, this is the Oak Trader report for the 5th of February 2014. I thought I'd wait till the midweek action had progressed just to update on some main markets here. And this is being recorded at 10:30 Hong Kong time. So it's 9:30 New York time on the 5th of February. And these charts were put together into the slideshow about an hour ago. And just at the end of the screencast, we'll take a look at the Dow and how it's behaving as well. Okay, as I said before, we're just going to be covering some main trading markets for the public. Here's the E-mini S&P 500 monthly chart. You can see the huge bull run the market's been on. We'll look at this as one section, two sections, and then if you've listened to previous Oak Trader broadcasts, we've talked about this being the third section. But again, people could have looked at this move up here and counted it as one big consolidation here. So 1, 2, 3, or the consolidation here makes it 2, 1, 2, and this is the consolidation and the breakout to make it 3. And this is the conclusion I came to about a month ago, I believe, in the broadcast that I put out. And you can see here how it's broken up and the market's had a correction in the last few days. I believe it's a 10% correction. But it does get people panicking. But again, you must remember there are solid principles with individual shares. They do have different action to the market. Sometimes they don't. Sometimes in the main they might follow the market. But individually, one must look at each share on its own perspective to make an opinion on it. And if it doesn't break a long-term 45-degree trend line on the downside after distribution, then we can merely look at this as a shakeout, and that's a guide I've always used, and Ted Warren used to use that as well. But it's a very, viable and good way to look at it, because it is always hard to choose a selling point, especially if you've been riding the bull market up for a few years. But you can see here, even if we draw a line here where my mouse is, drawing a line up, we still haven't come close to that line yet. We could see this market make a head and shoulder type pattern and come down to around the 1620 level, and then we can maybe see if there's any distribution here. But I just wanted to point out the previous distribution chops back in 2007 and 8, and then again in 2000 and 2001. There is always plenty of warning. No need to panic, the world's not going to fall apart tomorrow. There'll always be a decent bit of warning here, even if it's sometimes a massive shakeout and move down like that, and then the move coming back up. So again, there will always be some warning there. Never panic just because the market's gone down a few days in a row. And this is the monthly chart for the Dow, and again, similar picture here. You can see the uptrend developing from the early part of 2009, and then the big breakout from this consolidation area and the upward move possibly could be considered a little bit of distribution. We'll soon know if it comes back down and then struggles to move back up above this area of distribution here. So we're looking at around the 15,500 level once it's settled down, perhaps. If I draw a trend line along here, somewhere around the 14,600 level, the 14,500 level. Perhaps it could even go lower in this shakeout, but I don't believe it's the main shakeout for the main correction. That potentially will come later on this year. We should see a little bit more action here. If this is the main correction distribution, we should see some sideways action, some distribution action here, which will give us plenty of warning to sell out of any of our positions. And again, always look at stocks individually if they've broken a 45-degree trend line. But if we draw a long-term trend line up here, we come to around the 14.5 level, and again, that's the kind of level here as well. The tighter trend has been broken, but nothing was going to keep up with that, and then it broke out on the upside, and we could see this market coming back to around the 14,000 level. I believed I talked about this about a month ago in terms of the correction and what it's looking at. It's very hard to time main markets, and again, you have to look at each individual stock on its own. I timed the Thai market at the early part of last year, March and April, quite perfectly with a lot of my positions, but again, That was down to trend lines being broken and judgment of on-the-ground circumstances as well, in terms of people's behavioural patterns. And if you look at the 5-year weekly here on the Dow Jones, this is the consolidation area that was up for debate in previous Oak Traders, and it looks much better here on a 5-year weekly in terms of a consolidation area or a breakout area. But again, you have to remember, I mean, these parameters on the charts are 500 points. There was a time, let's say throwing back to say 1987 when 500 points actually meant something. And of course with inflation and over time and the way the Dow Jones is rigged in some respects, it's not an index-based market. People drop out and more successful companies drop in, and that's why you probably over the very, very long term will see it rise. But if you look here, you can see it's a clear breakout from that consolidation and another breakout from this area. And if you draw a trend line up as well, it hasn't broken that trend line, and it could do that very soon. But usually if it does break this trend line and it scares people and say it comes down to 13.5, I would be very confident that the market would bounce back up to at least the 15.5 or the 15,000 level after it had its severe shakeout, if it was indeed the beginning of a correction or the distribution for a major change in cycle in the market. Because at some point the market has been going up for nigh on almost 5 years now. So one has to look out for these distribution moments in the market, but I don't think it's just yet. Again, we should see some more distribution action later on in 3 or 4 months' time, once this market corrects and bounces back up, and then we can analyse the price action from there. This is the nearest 1-year chart, taking the average of the front month futures from the Dow Jones mini contract, and you can see this consolidation area zoomed in, so to speak. It does look like a bit of top action here, but again, I don't think we've had a huge amount of wild swings. We could clarify that maybe from June it's been in a bit of a distribution cycle with some of the swings that we've had, or maybe say from September, because this was a bit tight here. But you see these points up where it spikes up and comes down and then goes up. But again, I don't really take much from a daily chart. I'm always looking for a longer term perspective, because it's very easy to get hook-winked when you look at the market too closely. And this is even closer. This is a 6-month chart of the mini-sized March front month futures contracts, and you can see here the way it breaks out, and the market has had a pretty severe shakeout. But again, nothing really to get too panicky about. You've got Yellen speaking, I believe, on the 11th, and various other cheerleaders probably going to come back into the market at some point. And then you've got the debt debate with the raising of the ceiling income. That might affect the markets in some way, and we could see some wild swings. But again, I believe the market will show plenty signs of distribution, and the market won't just top out like this. If anything, it might come back up again and then distribute about here and proceed to go down. But again, we have to wait for further price action to decide. Crude oil, WTI, West Texas Intermediate, not sure 100% why they call it West Texas Intermediate when it's based on the Oklahoma Cushing price. Obviously a lot of that oil does come from Texas, I understand that, but I think it's a little bit misleading. We all know about the pipeline that's being built from Canada. Once that's opened, American oil from Oklahoma in Cushing should be able to distribute a lot easier down to the ports and to be able to export out of the Gulf of Mexico. That's what a lot of people say the real reason behind the pipeline is, not to bring down energy costs in the United States. We'll just have to see in the future how all that pans out. But again, you can see on this monthly chart, great cycle action here, with a low cycle in crude oil. And you can see the spike up for the Gulf War in 1991 here, where my mouse is, and the market coming down, and the market just going from $20 to $40, even though that was a 100% move. Just the small parameters of the move, compared to the huge daily moves that we get in this day and age. And then you can see the parameters and the wild swings in the market here. if we zoom in on the crude oil chart, which we'll do, we'll be able to get a better idea short term possibly about what's happening. But if you take the mouse from where it is here back in 1999, you draw a line, it hits this trend here, it's a perfect trend line. You draw a line and you've got somewhere, with time factored into it, perhaps around the $60 level eventually, I believe crude oil will shake out to and move down to. But it does look quite promising short term, but on the longer term chart, this to me is looking like somewhat of a distribution triangle. There could always be sharp spikes out of distribution a cycle, but that's what we'll look at in a minute. But just strictly looking at it from a monthly point of view, long term, i.e. don't know what's going to happen in a month, 2, 3, 4 months, but in 6 months to a year I can see this market being down around the 60 level. Gold daily, nearest 1 year, taking the average of the front month futures contracts. It's clearly broken a downtrend here, just here, which is quite important time to watch the market. As a lot of you know that have been following the latest updates, longer term, i.e. the next year to a year and a half, I am quite negative on gold. I do believe it will go down further, but short term it does look like it's preparing for some sort of bounce or spike, and I do look out for these mini cycles within a much larger cycle in a market. You've had a double top here, creating what I call a kind of pyramid formation where it goes up and then comes back down again. We saw it back in 2012 on the cotton daily chart, and it looks perhaps to be making a bit of a move up. We've seen it recently on the coffee chart, but perhaps not as long in terms of the monthly cycle. But yeah, if you draw a line here as well, and then you draw a line down, it's kind of almost forming like a flat top here, which sometimes springs up quite violently out of that. And we'll just have a look here on the weekly chart where it potentially could go if it does have a spike up. This is the little flat top here. Potentially, if you draw a line from the top of this triangle perhaps to here, maybe the target would be around the 1350 level that it could spike up to, and we'd have to reevaluate it from there. But again, I'm using this pivotal point here where my mouse is at 1200, and again this one at roughly 1200 for the downside move if it does break out on the downside. So at the moment it's at that pivotal point where it's being watched at the moment. If you draw a line here from where my mouse is in 2012, the latter part of it, you can see the mouse draw a line down, and it conforms almost with the trend that we're on now. It may break up to 1300 like a fake rally, convincing people to get long the market and then absolutely collapse again. So longer term I'm negative on gold, and I'll show you why. I believe I've got a monthly chart after this chart, and I'll show you why on the monthly chart. But short term, potentially it might be looking for a little bit of a rally, over the next month or two, but I wouldn't really touch it at the moment. I think there's a lot more solid opportunities to be going into, but again, at some point, if it really did have a big spike out of here, we could see it from this, where my mouse is here at the top of the previous cycle, draw a line to the top of this movement here at the back end of 2012 and draw a line down. That gets you to around the 1500 level, 1550, and that would be under the previous range, and sometimes that happens as well. So we see it spike up to around the 1500, 1550 level, and then we see the market collapse. And as a trader, you have to look at these eventualities. It's expect the unexpected. You've got to look at 3 or 4 different scenarios. You can't go into it thinking that you're going to be dead right with every trade you make, and that's why trading can be so difficult, speculating on a shorter term basis, because there are a lot of eventualities that could happen here. But again, if you look at the pivotal points, the breaking of small trend lines, they do help you with analysing which way the market will go short term, or potentially what phase or what cycle, mini cycle, the market's in at the moment. And this is it on a monthly chart, and this is why I wanted to show you why I'm still negative longer term on gold at least. I'm not sure what it's going to do in 4 years or 5 years. I'm talking perhaps the next year and a half to 2 years. But if you draw a line here where my mouse is from the bottom of the previous downtrend cycle, you draw a line, and as it breaks away from this trend line, where this trend line is what breaks out of this long-term consolidation area, you can see that the trend line just about is touched here with this shakeout down to 690, 700. And if you draw a line up from there, you get to around the $1,000 level, and that's where I think eventually it will settle just above the $1,000 level, maybe a bit below that, with this previous consolidation area here. And I wouldn't be surprised to see that happen. But again, with gold and its speculative nature, and of course the times that we're living through at the moment, you know, it's very hard sometimes to judge a longer term trend in a market where, for example, if Yellen stepped in and announced a program for 3 to 6 months, you would see an abomination on the charts, an unnatural manipulated move. And that's something, you know, as traders, we have to bear in mind as well, that there's other factors in the market these days. There always has been, but perhaps not to the extent of what we're seeing through this period of history. US dollar index monthly chart, and again this is another reason why I'm negative on gold longer term, is I believe that the longer term downtrend's been broken. Pivotal points here showing good support on the upside, and previously we've talked a lot in other Oak Trader reports, going back for about a year now, or at least 7 months, 8 months, about how I'm very positive on the US dollar against the Canadian dollar and other currencies as well around the world. Check out those previous reports for guidance, because a lot of that is still valid, and you can get an idea of my thinkings upon Forex as well. But if you look here where the line is, you draw a line, it hasn't broken up out of that. If it breaks up out of that line, then that will be a sure sign to me that the dollar index will be moving at least somewhat higher. Even if it is a false move upwards, we should see it move up to around the 90 level with the false move. And I believe that this area here looks to be a very good area of consolidation, and the market is in an undecided period now, and you have to be very careful to watch these. If you look where my mouse is, to watch these trends, this is kind of developing into somewhat of a triangle breakout, and I would suspect it would be on the upside, you know, simply because the public in the last year or two have been so negative on the US dollar, and the amount of people that held gold or held silver or were negative on the US currencies was quite phenomenal at the time, and that belief is still held, and of course that belief is well founded. I'm not saying it's not well founded, but you know, in history, during longer term, perhaps mega cycles, we see large cycles within mega cycles, and then we see smaller cycles within large cycles, plans within plans. And it's like what I talked about on the Money and History article in terms of the British pound. In 1920, £1 would get you $6, then in 1940 £1 would get you $4, and then again in 1976 £1 would get you $2.56. So it was a very gradual depreciation over those 50, 60 years, and if you weren't watching the market carefully, or you kept up to date with these things, as the generations die off, people forget that the pound used to garner you $6. And we used to see articles in London, UK newspapers back in 2007 talking about how great it is to go to America because the pound was at $2 to £1. Nowhere did the journalists mention that £1 used to get you $6. So these longer term cycles are huge, and the US dollar has gained tremendously against the British pound over the last 85 to 100 years. But during those 85 to 100 years, there's been 5 to 6 year cycles where the British pound has gained against the US dollar. So you always have to bear a lot of different things in mind when you're trading. Okay, that's it for now. Look forward to speaking to you soon. Any questions at all, email Kemp, and I'll be happy to get back to you over the next 24 hours. Okay, take care. Bye for now.